Hi everyone, welcome back to Corporate Decoder, where we decode the secrets hidden within financial reports. This latest filing from Primis Financial Corp shows some interesting moves, especially with a major division sale and a peek at their future plans. But there's a big elephant in the room we need to talk about. Let's dive into Primis Financial Corp's latest quarterly report. They started off the year with a bang, or at least a significant structural change, by deconsolidating Panacea Financial Holdings. This move meant recognizing a pretty hefty gain on their books, over $24 million, which definitely boosted their earnings for the first half of the year. Now, looking at the actual earnings, the first 3 months of 2025 weren't as strong as expected, with net income falling compared to the previous year. This dip was mainly because they had to set aside more money for potential loan losses, a whopping $5.2 million more. Plus their everyday costs, what they call non-interest expenses, went up too. But when you look at the first 6 months combined, things look a lot rosier, largely thanks to those Panacea financial gains we just talked about. Net income available to their shareholders jumped significantly, from about $5.9 million to over $25 million. It's a huge jump, but it's important to remember that a big chunk of that is from selling off part of their stake in Panacea Financial and valuing that remaining stake. Their profitability from core banking, what they call net interest margin, actually improved a bit. For the first 3 months, it went up to 2.86%. And excluding some tricky loans in their consumer program, their core margin was even better, hitting 3.12%. This suggests that even with those tricky loans, the underlying business is getting a bit more efficient. However, the real story here, and a big concern for the company, is what's happening with their loans. Their allowance for credit losses, which is money set aside for loans that might not get paid back, increased dramatically. For just the first 3 months of 2025, this went up by over $5 million, and the overall picture for loans shows a big jump in problem assets. Non-performing assets, basically loans that are seriously behind on payments or on the verge of default, shot up. As of June 30th, they represented 1.90% of their total assets, a massive jump from just 0.29% at the end of 2029% at the end of 2024. This is largely driven by some big commercial real estate and commercial loans where the borrowers are struggling. This increase in bad loans is a major red flag. Primis Bank itself has a large chunk of its loans tied up in commercial real estate, which is always a bit risky, especially in uncertain economic times. When you see nearly 30% of their total loans in this category and then a big chunk of that becoming non-performing, it really puts pressure on the company's stability. To manage this, their allowance for credit losses as a percentage of total loans has also increased. It's now at 147%, up from 1.86% at year end. While the percentage itself might not sound alarming, the dollar amount is significant, and it signals that they're bracing for more loan defaults. On the flip side, their mortgage operations, Primis Mortgage Company, are showing some growth. Loan volume picked up, but there were higher personnel costs because they brought in new sales teams. So while the top line numbers look okay, the costs are also rising. They're also still dealing with operational issues like running 2 core banking systems, which they're trying to fix to save money. Looking at the balance sheet, total assets grew, but liabilities grew even faster. This means their equity position, while still positive, is under pressure. They're heavily reliant on customer deposits for funding, which is generally good, but the increase in loans means they're putting more of that deposit money to work, and that comes with risk. Despite the issues with loan quality, their capital ratios are still above regulatory requirements, which is a good sign. They're considered well capitalized by the bank's regulators. This gives them some breathing room, but the deteriorating loan quality is definitely something to watch closely. Now, looking at these results more broadly, Primis Financial Corp is in an interesting spot. They're trying to grow their core banking and mortgage businesses, but they're facing significant headwinds from a challenging economic environment that's impacting their loan portfolio, particularly in commercial real estate. The deconsolidation of Panacea Financial is a strategic move that brought in some one-time gains, but the core challenge of managing credit risk remains. The increase in non-performing assets is a serious concern, and whether they can navigate this downturn while still growing will depend heavily on their underwriting and risk management. The fact that a significant portion of their loan portfolio is in commercial real estate and a piece of that is now underperforming definitely puts them in a more vulnerable position. Alright, that's our breakdown of Primis Financial's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to join the conversation. Thanks for watching. See you next time.